What's the biggest money mistake that you see? Maybe it was yourself in that age, or you see people around my age kind of making, or maybe you see me making.
The biggest mistake any young person can make is saying, "Oh, I'm I have plenty of time. I can start later." That's the biggest mistake. You cut the time by less than half, but you cut your wealth by more than 75%, right? Going from 32x to 8x.
Welcome back, everybody, to Satoshi Sundays number 10. I cannot believe this is our 10th episode, and this episode is going to be super, super special for you guys. We talk a lot on this channel about the creation aspect of building your career in the creator economy. We talk about how to leverage with AI, the different things you can do. We've just done 2 episodes diving into AI agents and how to set up your open claw. But part of Orange Peel is also using Bitcoin to protect your wealth. Our mission here is clear. We create value fast with AI, but we protect it forever with Bitcoin. No more of those fiat traps. Today, we are flipping the script and we are talking about what happens after value comes in and you need to stop leaking it to inflation, bad money habits, or even centralized custody. We are talking real money habits that young people should build now to stack sats for life. Dad, welcome back to the channel. How are you doing today?
I'm doing fantastic, kiddo. How are you?
I'm doing great. Let's get straight into it. So, as someone who has mentored through cycles, you've been around for quite a while. You've seen kind of how money does its thing. Why do your early 20s matter most when it comes to building good money habits?
The simple answer to that is time is your best friend.
Okay.
The longer you wait, the less time you have. Right? We have talked about this in the previous episodes. The more time you can give your money to do the work for you, the better it's going to be, and the lesser money you're going to need. Right? And that is the reason the sooner you start, the better it is. In your 20s, you should start for sure, because that's when most adults actually come into the workforce, start making some real money, pick up a career of their choice and whatnot. But if you can start sooner, you should start sooner. Remember, time is your best friend and worst enemy as well.
Interesting point. Let's unpack that further. We are living in an economy where we've got AI agents, we've got like unlimited access to information and the internet to help us learn things faster. But we also have fiat money, which is actively taking away our value. It's basically eating our gains, right? So when you're in your early 20s, you've got small paychecks and you've got big temptations. There's all these things around you that are going on, and you're like, I just need to spend money. I want to do this, 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 and this. Why should you prioritize maybe saving or building Bitcoin protection habits over chasing more income and trying to live a better life? Does that make sense what I'm trying to say?
Um, I'm not fully sure, but let me try to give you an answer based on what I understood, and you can correct me if that's not what you were looking for. I think what I heard from you was there is this constant tension between how you should spend, like how should you use your money in your early career, in your early adulthood. Should you prioritize saving for your future a lot more over living life and chasing higher income?
Yeah, basically. Yeah.
I think you cannot do one or the other. You have to do both.
Okay.
Why
How do
I
you get the
say
money
that?
to do both?
Yes. The most important thing is you don't want to be a penny pincher and try to save little paycheck that you have and just focus your entire energy in saving. It might feel good for a little bit, but in the longer run, you'll realize that the best investment you could have made in your early adulthood was in gaining skills that could have given you much higher income. Like, no compounding beats that. When you invest in yourself, you compound at a much faster rate. Even Bitcoin doesn't beat that. Right? As simple as that.
Okay. What do you mean by invest in yourself?
Investing in yourself means investing would come from two sides. One is taking time and effort and learning new stuff, learning skills that could give you better opportunities, right? For example, we've been talking about learning AI to build stuff, right? That's one side of it. The other side of it is sometimes just time and energy is not enough. Time and effort is not enough. You will have to put in money too. For example, if somebody is in a skill or in a profession that by getting a certification can give them 20, 30, 40, 50% raise, no money is going to compound at 50%,
That is true.
right? So they could take that little bit of money, get that certification, put in the time and effort, and increase the active income. Because what happens when you increase your active income is you can increase your savings rate too. Right. So if you were, let's say, we can take random rough examples, back of the envelope calculation. Let's say somebody makes $100 a week, right? And they can say, oh, I can only save 10%. I need $90 to live no matter what. I can only save 10. Sure, it's your first paycheck. Do whatever best you can. They get a new skill. They raise their rate, go to 150 a week. Now they could do multiple splits here. They could basically say, I can continue to live at $90 a week and I'm going to put $60 in my savings. Their savings will accelerate much faster. But what they could also do is, I'm going to increase my savings from 10 to 30. I'm going to take rest 30. I'm going to take 20 out of that, get some new skills, and take the 10, improve my life. Right? The burrito that I wanted to have, now I can afford a burrito a week. I can do that. I can treat myself. Now, this 20 that you spent on gaining skills that can help you go from 150 to 200 a week, to 250 a week, to 500 a week, right? So every time when you increase your income, if you start looking at, okay, what is the role of every dollar that I'm making, and put that dollar to work for that goal, you will achieve overall goals much faster. Am I making sense?
Yeah. Yeah. But it's sounding a little more like you should prioritize saving over your spend now culture. When in the beginning you said you think both are important, but it sounds like you're leaning one way more than the other.
I'm not saying, like, I was never in favor of spend now, but I was also never in favor of you don't live. Like, if you are 20-year-old, you're not going to be 20-year-old again ever, right? So things you can do at 20-year-old, you should do at 20-year-old. Like, you should not wait until you're 40 and you have a big bank balance to do things when your body doesn't support you, or your life doesn't support you to do those things, right? So I'm not a big fan of YOLO, but
Okay.
I'm a big fan of living your life. You you want to live wealthy, not die rich.
Okay, this makes sense. Where do you draw that line? Because I think I mean, the biggest problem that I have myself is drawing that boundary and then, having to decide what I can say yes to and what I can say no to.
I think this is an important thing to think about, because the most important thing in your life you'll have to learn is ruthless prioritization. Right? You can never do everything you wanted to. Right? I'll probably bring a reference from a book called 4,000 Weeks. Right? I read it probably 2 years ago, maybe a year and a half ago, something like that. But that book gave me a very different perspective. So what that book suggests is, on an average, a person lives about 80 years. And for easy calculation, let's round down a year from 52 weeks to 50 weeks. 50 times 80 is 4,000 weeks. Right? If you want to make it even more interesting, because most of us believe that life only happens on the weekends, weekdays are just, on the treadmill or the rat race. You have 4,000 weekends. That's all you have. So even if you wanted to, you cannot do everything you wanted to do. Right? That was a very important realization, because there are so many books about better time management, this skill, this framework, that framework. Ultimately, it boils down to what is more important to you. Right? That's what it boils down to. Now, here I would also bring in a framework that I love from Jeff Bezos. He basically came up with this idea of regret minimization framework. So he basically said, if I tried and failed, I would not regret that. But if I didn't try, I probably would regret it. Life could have been different if I tried it. Right? In other words, when you're on your deathbed and you look back at your life, how many regrets in your life you have? And your goal is to minimize those regrets. As few regrets as possible. Right? That's where living life comes, right? If for somebody, living life means that they want to go party out every weekend night, they have to go out drinking, bar hopping, sure, if that's what they really want to do, if that's what's important to them. Right? So figuring out what is really important to you is the most important part. And in that, you should always try to pay your future self. If people start thinking of the saving aspect in terms of, oh, I am paying my future self, I'm paying this $10 today to my future self 10 years from now, it changes the perspective completely, right? You are not trying to save money for something. You are paying yourself in the future, right? So I think changing your thinking about what is important to you and how you kind of think of all these things and where do you put in the priority list kind of starts giving you clarity on what is important, what is not important.
When you were 20, what was important to you?
When I was 20, first of all, I had no knowledge of money. I had no knowledge of personal finance. All I knew was I want to be rich and I want to make a lot of money. Right. And if I knew at 20 what I know now, my life would have been very, very different. Very, very different.
Yeah, I mean, fair.
Right. Because I have made so many mistakes, so many things I learned by making mistakes because there was nobody teaching me that. Right? And that is the reason the conversations we have had in the house in last 5-6 years around money and personal finance and whatnot, that's essentially to make sure you and your brother do not make the mistakes that me and your mom made.
What's the biggest money mistake that you see? Maybe it was yourself in that age, or you see people around my age kind of making, or maybe you see me making.
The biggest mistake any young person can make is saying, oh, I have plenty of time. I can start later. That's the biggest mistake. And if people have questions, we'll go back to the example we did a couple of weeks ago in one of the episodes about understanding power of compounding,
Yeah.
right? $1 compounding at 10% a year in 35 years is 32x. But if you cut it by 7 years, it's only 16x. If you cut it by another 7 years, it's only 8x, right? So if you and what you're doing is, because your end date is most likely same, like when everybody retires, or when do you actually start needing the money? If you take the US example, let's say around the age of 60, you start at 20 versus you start at 35, it could mean many different things. Many different things. Like every dollar that you put at the age of 20 would be $32 at the age of 60. Right? But if you put that money at $1 at the age of 35, it'll only be 8. Right? So you cut the time by less than half, but you cut your wealth by more than 75%, right? Going from 32x to 8x. As you only have 1/4 of the wealth if you cut the time by less than half.
This is kind of reminding me of that like penny example, the penny that doubles every day for the 30 days, but it's 29 times. Isn't it like day like 25 or 26 where the magic happens and suddenly it becomes like, I can't
Yeah,
remember what the exact date was, but it's something
I
I've
think
heard.
it's around day 27, if I'm not wrong.
Okay,
Until
okay.
day 27, it's like less than a million. Then
Yeah,
it
and then
goes above, like, okay, it's like 800, 900K, then it's like 1.8, and then 3.6, and then suddenly it's like 5.4,
yeah, yeah.
right? So it's the same thing. If you take the example that we talked about, if you start at age of 20, in 35, you're still 55. If you could give it 7 more years, this is 64x, right? So this power of compounding actually starts working after like good 10, 12 years. That's when the real compounding is visible in your portfolios,
Mhm.
right? So a lot of people make mistake of waiting or panic selling whenever there's a small correction in the market, right? And I'm guilty as charged. I made both of those mistakes.
Yeah, that's fair. I understand the power of compounding. I understand the incentive to put money in and just wait, but that doesn't help you make money now, right? And I think a lot of people my age, myself included, we're focused on trying to increase our income now so that we can live our lives now. Like, yes, saving for the future is important, but kind of how do you stop yourself from when you're looking at your, I guess, investments, and you're looking at the money that you've put into different things and you see the market going up and down from trying to just cash out pretty early?
Um, it's an overloaded question. So let's talk about
Yeah, you can break
one
it
part at a
down.
time,
Yeah.
right? So I understand when you are really young, your income is lower. So it might feel, oh, what can I do if I'm saving like $10 a week or $50 a week? What difference can I make? Right? Sure, it feels that way, but it's monumental if you build the habit. And the key part is building the habit. And this is what I mean. A lot of people make this mistake of, let me make more money, then I'll start saving. right? You lose time in this. And since you don't start building this habit early on, it's very hard to build the habit later because you can always fall into the trap. Oh, I'll start next year, right? Let me use this bonus that I got. I wanted that car. I wanted that handbag. I've always wanted to go on that vacation, that trip, or whatever it was. You could always keep pushing that. I will do it next year. And time is the only thing that you cannot catch up with. Right. So that's the most important part. So it's not about how much money you're putting at your low income. It's about building the habit that every paycheck, every time I make some money, a part of that needs to be paid to my future self.
So even if you're putting like $5 in,
Who
that's
cares?
fine.
Who
Okay.
cares? Right. And if anybody's interested, if you really want to see the magic, go in any compound interest calculator, put in that I'm going to save $5 a week, $10 a week, whatever you can, and use whatever rate you think is right, right? I'm not going to say, use Bitcoin's 29% or whatever. If you want to do S&P 500, do S&P 500, right? S&P 500 for last several years has done anywhere between like 10 and 13%,
Yeah,
give
it's
or
like 8
take.
to 10, yeah.
I think 8 to 10 is over a very long period of time. Like, ever since the money printing started, the rates have. So S&P 500 essentially gives you the debasement rate plus the CPI rate,
Okay. Yeah. Yeah.
give or take. So it's just keeping you afloat. It's not giving you anything extra,
Mm-hmm.
practically, right? So as the money printing accelerates, it's going to accelerate. That's fine. But assume, let's say 10%. Right? I'm
Mm-hmm.
not even going to say 13%. Put that number. See and give yourself time. Don't see what happens in 1 year. Don't see what happens in 5 years. If you're 20, see what happens in 35 years, right? 40 years, right? Just maintain that habit. And if you really want to get interesting here, you can basically say every year, I'm going to increase this, whatever contribution you're doing, by 10%, 20%, 30%, whatever, the way you project your income. If your income is going to grow, you're going to grow this thing alongside. It will give you the entire picture. And if you look at the charts will be like very flat and then they start going exponential. Right? But key thing is that building that habit. The second most important thing is a lot of the time, which is tied to the habit thing, but we have been trained to believe that income minus expenses equals to saving. Just flip that equation. Why could it not be incomes minus saving equal to expenses? Right? Instead of saying, let me see, if I can save anything after spending, you're putting a cap on spending. Unless you are a person who is completely financially foolish, you are keeping a cap of not going to spend more than I make.
Yeah.
So that's a cap. What if you lower the cap a little bit and say, I'm going to spend this much, and when this runs out, this runs out. Okay, fine. This means I'm not going to do anything for a number of days until I get my next paycheck. Right? But just flipping the equation, going from income minus expenses equal to savings to income minus savings equal to expenses is
Mm-hmm.
a much better framing. And it kind
Yeah.
of builds in your habit part in between as well. But that's an important part. Make sense?
Yeah. Actually, I've never thought about it that way.
So I'll give you a parallel to that, which is when it comes to taxes, one of my favorite but most hated topic. Difference between an individual taxes versus business taxes is, for businesses, it's income minus expenses, and then whatever is left, you pay taxes on that. For an individual, it's income minus taxes, whatever is remaining you spend of that.
Interesting.
That's how salaries work. The taxes deducted at source, then whatever is remaining, you spend from that. But if you're running a business, you'll say, okay, I make 100, but I spent 80, so I'm only going to pay tax on 20. Yeah. Similarly, this changing the equation of savings is very useful.
Mm-hmm. Okay, we've talked a bit about the habits that I think you should, or that you think you should be prioritizing in your 20s. But let's talk action and let's talk Bitcoin. And I don't want this to be like a if you're young, you need to buy Bitcoin kind of thing, because that's really not, I think, what we're trying to build here. But I do want to say, what about Bitcoin actually protects wealth?
The simplest answer is the absolute finality of scarcity.
That's a bunch of big words.
What does that mean? In simplest words, nobody, doesn't matter how much power they have, can print more Bitcoin. They cannot. And that also tells that nobody can control Bitcoin. And if anybody has any doubts, look at what happened in the last 6 weeks or 8 weeks between US, Israel, and Iran. US actually went ahead and crushed Iranian rial. It's practically zero today. Iran started buying Bitcoin. If you are a person who's in Iran at this point in time, you have choice that you could have your entire wealth converted into real estate, to stocks, to gold, or to Bitcoin. Ask
Stable
yourself,
coins.
stable coins, sure, but stable coins are not investment. Stable coins is money.
I'm thinking back to just the episode that we did on de-dollarization, right? And how this would be
No,
one of those cases where the
I'm
people
adding
would want.
another layer here. The another layer here is, if you are in a war-torn country, would you want to trust a currency of the country that's attacking your country?
Yeah, okay, that's fair.
Right? Because at the end of the day, they can control it. Right? People can say, oh, Tether is not a US company. Sure, Tether is not a US company. Agreed. Even though they not recently, it's almost a year now, they announced USA Tether. They also have a new stablecoin, USAT. But at the end of the day, stablecoin is backed by Treasury. Treasury is issued by US Treasury Department, right? Which are usually held at one of the big banks or wealth managers or whoever. If we have learned anything from what US did to Russia back in 2022, we know they can do anything with treasuries. So if I am in a war-torn country and I have this opportunity, honestly, ask yourself, like, what would you pick out of those things? If you pick stocks in your own home country, your stock market is crashing. US stock market, sure, but US can put sanctions on you because you are an Iranian and whatnot, and blah, blah, blah. If I convert it to gold, sure, I have sovereignty, but I want to leave the country. How do I take it? If I have real estate, I am tied. I cannot move this asset out of the country. If I have Bitcoin, I could remember the words, take whatever escape I have to, and nobody has to know how much wealth I'm carrying in my head. And funnily enough, if you look at last several weeks, Bitcoin has not shown any volatility.
Yeah, that's true.
It's just trading in that nice range between 68, 69,000 to 74, 75,000. Just In between that, a little bit up, a little bit down. Gold crashed today, like 4 or 5%. Oil was going down. Like oil goes up, oil goes down, doesn't matter, right? So, but Bitcoin is just hanging in there. Just chill. That tells you something. People can, like, nobody can crash Bitcoin. Nobody can control Bitcoin. Nobody can put sanctions on Bitcoin. Nobody can print more Bitcoin. If you understand all that and you understand why these things are important, and that's where studying Bitcoin or studying history of money is important, you'll find that there is no second best. There is literally no second best. Now, does that mean Bitcoin would be like the hyper Bitcoinization will happen tomorrow? Everybody will want Bitcoin tomorrow? I don't think so. Right? And if people are waiting for Bitcoin price to go to a fiat number somewhere, you're not in the Bitcoin standard anymore. You're still in the fiat standard. And you're just, comparing your wealth with a yardstick that is shrinking every day. Right? So I think the most important thing for people to understand, especially for the young people, is how can you protect your wealth that you create over time by working hard, adding value to humanity, to other people, and generating income that is converted to some sort of asset so you can protect your wealth. What is that one asset that requires you not to read the fancy charts, not to read financial statements, not to be the best stock picker, not have to worry about geographical constraints and whatnot, doesn't have to worry about this currency versus that currency. If you hold all USD assets, for an example, what if US dollar crashes tomorrow? All your assets will be decimated, right? Bitcoin doesn't care. Like gold doesn't care, for example. If you could move gold, you would not need Bitcoin. If gold could move at the speed of light without a third party, you would not need Bitcoin, right?
But gold's also not absolutely finally scarce, right?
Correct. But gold has a 5,000-year history, and there is enough scarcity that people believe, and everybody agrees. Like, you don't have to, if you talk to anybody, you don't have to tell them why gold is valuable. They might or might not hold that as an asset in their portfolio. That's a different story. But you don't have to convince anybody why gold is valuable. But Bitcoin is not at that stage yet. Is Bitcoin better than gold? 100%. 100%. I don't want people to take this type of thing that I'm a gold bug. I'm not a gold bug. I don't hold any gold in my portfolio, right? But I'm drawing this comparison just for people to understand that any hard money is better than fiat money. And when it comes to crisis, which we are living through, and I don't see this crisis reducing, right? I think it's only gonna expand from here is how I feel. And I like what Balaji says. He usually says after Orange Man, it's Orange Coin. So we already have Orange Man in the White House. So the next step is Orange Coin, right? So it will happen, but it will take its time. But all in all, as a young person, focus on making more income, build the right habits, pay your future self, and try to pay it in an asset that does not lose its purchasing power just because somebody sitting in the government decided to print more.
When you're young, is protection of your wealth equally more or less important than the accumulation of your wealth?
Financial industry has made us believe that these two things have to be mutually exclusive.
How so?
What do I mean by that? The whole idea of 60-40 portfolio, for an example. Stocks, growth, they're not good capital preservation. Bonds, great at capital preservation, but not good at growth. Put a mix in your portfolio. One helps you grow, the other helps you protect. The real problem is hidden. My purchasing power is not getting lost when stocks go down. My purchasing power gets lost when politicians decide to spend money that they don't have. There is no two ways about it. I don't care red, blue. I don't care, you support this bill or that bill. Every politician likes to spend money, and they're spending the money that we don't have. So the only way they can spend is print. And by printing money, they're stealing your purchasing power, right? So that's the real thing. Financial system made us believe that capital preservation and wealth accumulation have to be mutually exclusive. Bitcoin breaks that. Bitcoin breaks that in a way. You focus on accumulation, Bitcoin does the job of preservation. How does that work? You work, you create value, you generate income, buy more Bitcoin. So you are accumulating more. And Bitcoin sits there and says, all right, governments, you can print as much money as you want. I'm chilling here. My owner, my holder, I'm preserving their purchasing power. You can do whatever the hell you want to do. Right? Bitcoin is not going up. Bitcoin is not going down. The yardstick that we use to measure is the one that's fluctuating. So in that world, I think as a young person, your focus should be more on how can I add more and more and more and more value so I can generate more and more and more income. And then I take the part of income and pay my future self in the asset of your choice. Yeah.
And it doesn't have to be Bitcoin, but it probably should be Bitcoin.
Correct. But not a financial advice. I would simply say, understand the problem. Right? What's the problem with stocks? Why has NVIDIA share been trading in the same range for last 6 months? Is NVIDIA a bad company? No. Is NVIDIA not, posting record profits? Yes, their every quarterly results are better than the previous ones. Their earnings are better. Their projections are better. Things are not moving, right? Why is Microsoft down 20%, 25% from their top, right? Why is Amazon down 20%, right? Why is NASDAQ down 8-10% from the beginning of the year, right? So if you start asking this question, it requires you to understand, okay, which company is going to do better now versus that. Like you can either be a stock picker or you could be a person who delivers value with whatever craft you have, right? Like we've talked in previous episodes, every human on the planet didn't need to be an investor. Broken money forced us to be an investor. There's nothing else there, right? If I go back in the history, if I look at my grandparents' generation, right, in India back in the day, they didn't have to worry about investing or if I have to put this money somewhere, otherwise I won't be able to buy the house that I want to buy. They're like, okay, that's the house I want. It comes for this price. I'm going to start saving in n number of years. I'll reach that place. I'm going to take that money, go buy the house. So house prices were flat, like will change slightly. Gold prices were pretty much flat in that time as well. Only people who had surplus money because the value they were creating was generating a lot more income that they could consume, they were the ones who were like, okay, you know what, let me buy something for my future generations. Like, but an average human, average person didn't have to be an investor. But today, you cannot be not an investor. If you're keeping your money in the bank, in the so-called high yield savings, you are being ripped off.
What are your thoughts then on things like having savings funds, emergency funds, Roth IRAs, etc.? All the different types of like savings that you're supposed to start and have.
I think this eventually this boils down to individual situation. People say emergency fund, savings, whatnot. In reality, what you really need is liquidity. What
Yeah,
does that mean? What does that
a
mean?
big yeah.
That simply means if there is an emergency, you lose your job, something happens, right? You have rent due next week, but the paycheck stopped. You should have some way to generate money to pay the rent so you don't get evicted, right? That's the whole idea. The real thing is liquidity, but for normal people, liquidity is very complex to understand, right? People usually understand liquidity as, oh, I have money in my bank. It doesn't have to be. Let's say somebody has 100K stock portfolio, like index fund. I'm not even going to say single company, whatnot. If you lose your job and you need to raise some money, you have multiple choices. You can sell some of your shares. Sure, market is down. You'll be forced to sell at a lower price. Big deal. Money sitting in the bank was anyway not earning any interest rate. And if you don't need that savings fund for 5 years, guess how much money you lost? The other thing you could do is you can borrow against your 100K portfolio. If your portfolio is 100K and you borrow $5,000, sure, you might have to pay a couple $100 in interest, maybe like $300 for a year, $400 for a year. Much better than the credit cards. Okay. So other things is like, if I, like, for example, if we have to go to ER tomorrow for something and I need to generate cash, I'm not sitting, let's say the bill is $20,000. I'm not keeping $20,000 in my bank. I can swipe my card. That gives me 30 days to generate the cash and pay it off, right? In 30 days, I can generate more income or get money from my assets. So in reality, it's about liquidity, less so about savings fund. But they kind of brand it as emergency fund because that creates fear and it sells. Okay? I'm not saying emergency fund is bad, but the real thing is you need to have liquidity if you need some. If you have that liquidity, you don't need to keep a savings fund.
What kind of liquidity can you have when you're young, when you're in college, apart from just cash in a bank account?
Uh, when you have, so when you are young, one big thing is your liquidity is your parents, believe it or not.
For some people, but not for everyone, right?
For majority of people. Like
Okay,
if
fair.
you're 20 years old, if you're 20 years old, you can't have a savings fund of 40 to 10, 20, $30,000. You'll probably have what, like $1, $2, $3,000, right? You can generate that kind of money from your parents, from your friends if you have to. When you are in your 20s, I would not worry about saving for an emergency. I would focus on paying my future self. What is the worst? In the worst case, you have to sell that. right? That's the worst.
So
But
Bitcoin is not liquidity.
Bitcoin is in ultimate liquidity. If nothing else matters, you can always sell it. You can sell it whenever you
Okay, so
want,
it's a lasting
24/7.
liquidity. Okay.
So if you think from the perspective, if your money has layers, you have some money sitting in your bank account. You have credit card, you have some money sitting in your bank account, then you might have a fixed deposit or a certificate or CD in the US term, or you have like the bonds or the the money market and whatnot. How would you spend? You'll first start tap your credit card because that's your liquidity that gives you interest-free loan for a number of days, usually between 30 and 40, right? And then you go to the next layer. You can withdraw from your bank. Then you go to the next layer. And if something happens, you can sell your money market funds. Then you can go to your break your CD, and then you can go to your investment accounts, right? So, if you start replacing this for a 20-year-old, your hierarchy is you have your credit card, you have your parents, you have a little bit of money in your bank. Again, I'm not saying don't keep any dollars. Keep like good 30 to 45 days of expenses with you. That's all you need. Because in today's world, if you need income, you can always find work. If nothing else, you can, like we talked about it, you can drive an Uber, you can do food deliveries, you can do grocery deliveries, you can do bunch of different things. The things that you can, if you want to, you can pick up your phone, sign up, and you could be driving in like 24 hours, less than 24 hours,
Mm-hmm.
right? So you can generate income if you really want to. Like, so I would not worry too much about that. My emphasis would be keep your daily expenses with you for the next few weeks. Don't bother about 6 months. Don't bother about 12 months. Focus on building the nest egg. Bigger the nest egg, the smaller you need your emergency savings to be. The most important thing as a youngster here is do not pile on debt when you are young. Do not, especially the bad kind of debt, the credit cards, the consumer loans, the buy now, pay laters. Don't do that. Do not.
Do you believe that there's good debt and bad debt?
Yes.
Okay.
Yeah. So good debt is any debt that you use to buy assets that create value for you and grow at a faster rate than the rate that you're paying for the debt. That's a good debt. Mortgage is a good debt. Right now, as a in reality, I would say real estate is not as good of an investment. But in general, real estate grows better than what the mortgage rates pay. That is the reason people buy houses. Right? Like there are people who borrow to buy Bitcoin. If anybody doesn't know anyone, look at Michael Saylor. Their entire company is standing on that thesis. Borrow money, buy Bitcoin. In long run, Bitcoin would grow faster than the interest they have to pay, even with their perpetual preferreds. They will come out ahead. Right? We talked about this in previous episodes. If you can borrow at 0% and invest at 4%, you'll borrow as much money as you can.
Yeah.
Right?
Keep pocketing the 4% forever. Yeah.
Yeah. And if this 4% stays and the whole thing can move up or down, who cares?
Yeah.
The problem is when this gap starts narrowing. Right? So there's a good debt in that term. Like if you're borrowing to buy an asset that's going to grow faster than the rate of the debt, it's a good debt. Right? But you should not borrow more than your income can service because
Mm-hmm.
that causes for liquidation. right? All these leverage blowouts that we see every day in crypto and speculative markets, that's because they leverage themselves so much that small moves can wipe them out. Right? We talked about this for the and a simple example, like people don't think about this every day. When you buy a house, you are leveraged 5-1. You pay 20% down on 100% of the price. So $100 home, you pay 20%. A 20% swing in the price. So if 20% house price corrects by 20%, you are wiped out. Your equity is zero. Good thing is, houses are not marked to market every day, right? And usually the mortgages are fixed term mortgages, so banks don't do those mark to markets as long as you keep paying the mortgage payments. Bank doesn't care, right? Imagine if home prices you could check tick by tick like you can do for Bitcoin, like you can do for other stocks. Like the housing market won't be what it is today.
Now I'm just thinking about some of the daily changes that you can implement, or maybe that I could implement now in order to start paying my future self. So I'm wondering, if you were where I am, what were some of the things that you would change?
So one way I would think about this is every sat that I stack and put it in my vault, that's for my future self. I would only focus on, like, if I've built the discipline that anytime, whatever money I have, you don't have to, say I'm going to do this much. You can simply say, okay, every week, either you can set a minimum, I'm going to put this much minimum and try to stick to it. Or you can say, any amount of money that I make, I'm going to put X% with the minimum of this and a maximum of that, right? For an example, let's say somebody makes $500 a week, right? They can say, I'm going to put minimum 10%, right? So minimum $50 a week, right? And in the weeks that I'm going to make more, I'm going to increase it proportionately, but I'm going to cap it at $100. So if any week I make $1,100, I'm going to put 100, and the rest money I can do other things. I can buy courses, learn skills. If I can buy the clothing that I always wanted, or live a little, or do whatever I need to do. Right. The key thing here to note is that every time my income grows, I have to pay my future self. Like, I have to increase the paycheck of my future self too. Right? You can't say, today I'm paying my future self X. I was making Y. I started making 2X, twice the Y, or 2Y, but my future self still gets X. Right? It should be increasing proportionally, if not faster. Ideally, it should be faster because this is starting a smaller percentage. You can increase it much faster.
Mm-hmm.
Right? And that way you also don't get into the lifestyle creep where, if you could live on $400 a week, now suddenly your income is $800 a week, so you started living on $800 a week.
The biggest takeaway from this for me would be flipping the income minus expenses equals savings to income minus savings equals expenses. I think that that's a pretty solid way to look at things. That being said, let's wrap this up. Let's bring this home. Dad, what is one habit that viewers can start today to achieve all of the things that we talked about, for lack of better words?
I think the first thing that anybody who's serious about money is start learning about money. That's super important. Otherwise, you will fall into the trap. You'll go to YouTube and you'll see people buying options, going on the poly markets, betting here, betting there, and whatnot. Don't do that, right? If you study money, you'll realize all these things are side effect of how our money operates. Our money promotes gambling culture.
Correct.
Simplest form, because purchasing power is stolen from people. They need to find ways to make more. Their paychecks are not going to increase at the same rate. Right? If anybody's paycheck is increasing 10% every year, they are doing better than S&P.
Yeah. Yeah. What specifically is there to learn about money? Are you supposed to learn about the history of money, how the government deals with money, about the stock? Like, what specifically about money are you supposed to start with?
I think the most important thing to learn about money is how money works and what is the actual purchasing power loss of money every year, because that's your hurdle rate. If you're not beating that, you're not doing good. If your money is depreciating at 9-10% and somebody's selling you a 5-year CD, guess what? You're guaranteed to lose money. Guaranteed.
What's the best place to start learning about money?
I would say, like, I know this is a Bitcoin podcast, but I would recommend a book that is not Bitcoin. I would start with The Psychology of Money by Morgan Housel.
I knew you were going to say that one.
Um, that doesn't tell you the history of money. So don't get me wrong. What that tells you is that kind of gives you a decent understanding in very simplest words, power of compounding and how simplicity usually wins. Usually, if you keep your investing style simple and let time do the needful, you most likely come ahead. And remember, we talked about it. Was it last episode or the one before, where we said the dead people portfolios are the ones that are performed
Yeah, it was the last
best,
episode. Yep.
right? There's a reason, because there's nobody sitting there and tinkering with them, right? As long as you bought things that are not affected by one CEO's decision, right? You're okay. So if you bought index funds and you lost password to Fidelity, and then or you lost track of time, and then 30 years later you come back, you'll be shocked at what you hold now, right? Same way, if you buy Bitcoin, put it in your hardware wallet, secure it somewhere, make sure your backup recovery process is sorted, you have tried it, it works, go to sleep for 30 years. Wake up after 30 years, your purchasing power will be intact, if not much better, right? So understanding how money works is the most important part. Once you do that, you'll understand what the problems with the current money is, and then that will automatically drive you to the assets that you believe solve the problems that you acknowledge or that you agree with.
Pretty great note to leave things on. I like The Psychology of Money. That was the very first money book that you gave me to read. And I actually read. You had handed me some other ones before then, but this one was the first one that I actually read. From there, I'd say Broken Money was also a great one, because that one's more on the history of money. So that's what worked for me.
Broken Money is a good one. The only challenge I found with Broken Money is,
It's
first of all,
dense.
it's very dense,
Yeah.
and It's very, very big book. It's a
Yeah.
really big book.
It's this fat
You
thing.
you
Yeah.
yeah you can't sit on a weekend and finish it. Psychology of money you can.
Yeah.
Bitcoin Standard you can strive. You might be able to. Otherwise, 2 weekends you're sure you'll be done. Broken
Yeah.
money.
Yeah. Yeah. That one took me some time to get
Yeah,
through.
it took me more than 4 weeks to go through Broken Money,
Yeah.
and half the things went over my head because I didn't
Yeah.
understand
Yeah. It's
economics
probably due for a
that well.
reread at some point.
Yeah, yeah.
Yeah. All right. I think that brings us to the end of today's episode. That is everything that I had to say. Dad, do you have anything you want to add?
No, this was great.
Yeah, sweet. If you are in your 20s and you watch this segment, this is going to be the episode that I think is the most important for you because money's important. That's what we talk about on this channel. And anyone who tells you, money's not the most important thing in the world. Well, it might not be the most important thing, but money is pretty much up there. Anyway, not the point of what I'm trying to say. I hope you guys enjoyed today's episode. And yeah, I think next week we might be going a little bit into the personal finance aspect of things. I still have to plan that one out, but this is kind of what I was thinking for now. I want to pivot away from the build with AI, leverage with AI, and talk more about the protecting your wealth aspect for a few of the episodes because we've gone very, very deep down the AI rabbit hole, and both sides are equally as important. Anyway, so let me know what you guys thought in the comments. Good things, bad things. If you have any questions for me or for my dad, as always, you can reach out to him at Global HODL on X, and that link will be in the description. With that being said, stay curious, stay skeptical, and stay orange pilled. I'm your host, Nikki. This is my dad, and we will see you next Sunday for Satoshi Sundays number 11.